Yeah, good afternoon, MarketChameleon.com. I'm Adam. That's Dmitry over there. Say hi, Dmitry.
Hey guys, how's it going?
Awesome. Great. Great to see everybody. It's a special afternoon session. I told you, everybody. I told you, you got to click that subscribe button, tick that bell, because we come at you. You never know when. And that's why you got to, if you're here on YouTube, click the subscribe button, tick that bell so you catch us live. If you're on MarketChameleon.com watching this a little bit later, you can click the subscribe button on the right-hand side and follow along with the data and analytics we're using today. Today, we're going to be building this is part 3 of our trading model series. Are you psyched, Dmitry, or what, man?
Yeah, I'm really psyched. I even created like a little bit of a slideshow just to recap what we did and move on.
Let's do it. Why don't you go ahead and
Let's see
share your
how.
screen, Dmitry, while you're doing that?
Okay.
I will tell everybody that option trading and all trading is risky. So you need to be careful out there. We're just giving you ideas. We are absolutely not telling you what to do. Hopefully helping you in your trading, building your trading models, helping you do that. But you need to be careful. And we are not telling you what to do at all. You need to do your own stuff. So go ahead and remove
Yep.
my face there. And boom, Dmitry sharing his screen. Nice job, brother. What are you
Yep.
going to bring to
Okay.
us today?
You see everything fine?
Yep, got it.
All right. So I just wanted to recap really quickly what a trading model is, and then we'll just move on in what we did prior to today.
Sure.
And essentially, when you look at a trading model, there's a difference between a trader and an investor.
Yep.
An investor is somebody who likes a company, maybe likes their product or likes the management, believes in them, and like say Apple Computer, and they're going to buy that stock, wait 5 years and see what happens, which is perfectly fine. I do that.
Sure.
Many people do that, but that's an investor. A trader is something completely different. A trader looks to buy and sell risk and profit from those transactions, just like a business does.
Yep.
So the goal of a trading model, it's really to generate consistent positive returns over time, just like a business does. So if you have a trading model and you have, let's say, $20,000 you think you're going to risk in many trades this month, you're expected to make more money. You're going to have more money at the end of the month that you started out with. So if you took $20,000 and did 40 trades, $500 trades, you're going to win, lose, but at the end you're expecting to make more than you came out with.
Absolutely.
When you create a trading model like that, when you have those types of rules and something like that in place, it becomes an asset, just like a piece of real estate that has you buy a risk asset, you have expenses, you have a mortgage, but you also have money coming in. So if you have X amount of expenses and you bring in more money than your expenses, it's an asset, right?
Absolutely.
It's something that makes you positive returns.
Yep.
And that's what the goal of a trading model is to create an asset which generates returns. And by the way, many people either they could sell their trading models, to a hedge fund or raise money to put more money in there,
Absolutely.
start their own hedge funds. So that's how a trading model works. And some of the most important aspects of a trading model is you work around defined rules. The model also should be flexible so you could tweak it, and it should be measurable. The performance of it should be measurable. And what I mean by that is when we talk about defined rules, almost any successful person who's a trader will have rules in place, defined rules in place. Because once you go into a trade, you have no more objectivity.
Yep.
Right. And then anything could happen. But when you stick to your rules, then you have a model in place, and the model really should be something that you're able to tweak, and you're really able to measure if it's performing the way you're expecting it to perform. And like, for example, even any business, it applies to any business. If you're a restaurant owner, right, and you think, well, for this month, I'm going to have these amount of expenses. I have to buy this amount of food, and I'm going to have $20,000 worth of expenses. I expect to make $30,000 based on this many customers coming in and the average money that a customer spends.
Right.
I predict there'll be 30,000. So that's a good So that's a good business model, right?
Right.
If
I mean,
you're
it's like
investing
looking at. I
personal
mean,
20.
I liked the way you put it before. Of if you're the casino, right? You know, kind of what your return's going to be in general. You're going to have wins, losses,
Right.
but you know what you have an idea of what you're going to do, what returns you should be getting, and then you can measure against what you expect, right?
Yeah, right. You don't look at every single, you look on average,
Right.
how many people come in, and on average what you're going to make per customer. You're not really looking at, well, this customer walked away,
Right.
we lost to this customer.
Yeah, yeah, yeah.
That's part of
You can't look at it that way.
business.
Yep.
Right, and that's part of business, and you should be able to. So you have a process in place. So the first thing is you do have a process in place. You have a model in place, and the model should be able. You should be able to tweak it. So, for example, if you're, let's just come back to the restaurant.
Sure.
Let's say you spend 20,000. You're expecting to make 30,000, but you made only 18,000. You lost $2,000. Well, where did you lose it, right? It
Right.
has to be measurable. Where did you lose it? Maybe you didn't sell enough alcoholic drinks. So then you're going to tweak it, and maybe your waiters or waitresses
Exactly.
will say, would you like something to drink before they ask you to order something on the menu? Or, maybe there's a certain item on the menu that people send back, and it became a loss for you because you had to incur those losses. They didn't like it. You didn't want to lose customers. So you're going to change your menu,
Yep.
right? You're going to change it, and you're going to tweak it until it becomes profitable. And you have to approach it as a business. So you're measuring where did you what did you expect, and where
Right.
did it where did you flaw? What kind of
Exactly. So
what
one
happened?
thing in that just popped to my mind. Maybe you didn't take into account events that were coming up, right? So you had a model
Exactly.
based on
Right.
something that didn't take into account potential events that were coming up, right? So maybe then next
Exactly
time you
right.
got to include known events that are coming up into that model, right?
Exactly right. Like, say you had a model that you decided, I'm going to consistently, I'm just making something up, but I'm going to consistently sell credit put spreads, 2-week credit put spreads,
Right.
and you sell, and then all of a sudden at the end of the month you thought, well, or at the end of a certain time period you thought, well, I was expecting out of the $20,000 to make 25, but I only made back 18,000. What happened? Well, you look back in your model. Oh, I always lost on those earnings events.
Right.
I have to take those out. I shouldn't be trading. This model, needs to be tweaked.
Right.
So
to not trade
so
around earnings. Right.
to
Exactly.
not trade
Yeah.
around earnings or
Right.
any type of right. Or maybe certain times, even in the market, maybe when the market is doing something, um, maybe falling a lot
Mm-hmm.
or whatever it's doing, maybe at those times the model doesn't work, and you're going to have to start tweaking it along the way to make it optimal,
Right.
right? And that's how a trading model works. And
Awesome.
when you have all those pieces in place, right, then you have to treat it. This is your asset, right? You have to treat it like your asset, and that's it. So let's just move on then to the next slide. That's fine then.
Yeah, man. Got it. Totally.
When before we move on to the next part of the model, which somebody brought up with risk management, risk and reward, we did talk about valuation, why it's important, whatever financial instrument you're trading, to have some theoretical valuation. So then you could compare the price, the market price, to your theoretical value.
Right.
This allows you to determine, well, how much edges there is. Am I getting a good deal or a
Right.
bad deal? And how much potential reward there is. And we use an example, and the easy example would be, well, if I took an ETF and calculated the net asset value, how does that compare to the market price?
Right.
And if they're deviating, then there could be an edge there. And
we'll get into that a little bit. I mean, this is one of the services the Chameleon provides, is doing some calculations within these for you. Like, how would an
Right.
average person even begin to calculate theoretical value, right?
Right.
So this is what the Chameleon does. This is one of the main advantages of the tool: the edge, the values. Yep.
Yeah, and the NAV, for example, that is simpler. You know the components, you know
Yep.
what weighting is of each component, but a lot of financial instruments you cannot price that way, right? There's no they haven't maybe they have an intrinsic value, but it's not just an intrinsic value. So there's different ways to calculate it, and we could go into it, but there's different models, either statistical models, you have comparative analysis. So there are different ways to value it, but yeah, it is important to know, well, how far away is the price from my theoretical value and why.
Yep.
And then we did talk about that, and I wanted to discuss risk and reward.
Mm-hmm.
I do get a lot of emails talking about, well, talk about defined risk, talk about how do I measure reward and risk, and that's kind of what I wanted to get into. And simply, risk, it's how much you can lose, right? You enter into a trade, it's how much you could lose. The reward is how much you could potentially make. And these two, you have to look at them together. And this is going to help you make good decisions. I'm going to exit here just like last time.
Sure, no problem.
Let's just put up a paint here. And I'm just going to start showing an example and writing it out. And right now, so we're going to talk about risk. Let me make that bigger. Is that too small?
Yeah, make it a little bigger so people with watching on their phones and stuff can see it.
Right, risk. So let me see if that's.
Are you the Paint master?
I'm trying to be.
A lot of people are like Microsoft Paint. It comes. I'm like, it comes on every product that Microsoft ships.
Right.
It's one of these little known products. People don't even know it's there.
Right. It's great, and I've been looking for tools. I have to find a different tool. I've seen people use where they get really fancy with being able to write right on the screen.
Yeah, the only thing I don't like about that is I don't like people handwriting stuff, because most people, you can't read their handwriting. It's awful. So I'm a much bigger believer in typing.
Yeah, me too.
Yeah.
I like having things in front of me. So when I'm talking about it, just having it, and that's part of the things with models. You want to have everything in front of you so you can make a good determination if it's a good trade or not.
Sure.
And really, simply put, risk, that's something you're always trying to minimize, right? You always try to reduce your risk as much as possible, and reward you always try to maximize.
Sure.
Right. And that's the goal here. Did I misspell that? Maximize. But you get the picture here.
Maximize. I love it, dude.
Yeah. We're trying to maximize.
I'm maximizing the heck out of this trade.
Yep. So let's look at a scenario here, which everybody first will understand. And it's kind of like, I like to put visuals there and something that anybody could understand. And this, my kids should be able to understand this. I think they're my 10 and 12-year-olds, because I asked them this and they understood it. So let's first look at the risk-free, right? Risk-free rate. And you have these two scenarios.
Okay.
Right? We have, you have Bank A, right? And you have, let's say, Bank B, right? And you have, let's just say, a 6-month CD here. And you have a 6-month CD over here.
Yep.
Right. This one is paying, let's say, 2%, and this one is paying 2.25%. Right.
Yep.
Right now, when you're looking at this, the option is easy. Right. You should be picking the higher, this CD.
Yep.
Right. It's paying more. These are both the same risk. So let's just say they're insured. So they're risk-free, and one bank is paying higher than the other bank. So in this scenario, it's very easy to know which asset, where you should place your investment.
Yep.
In Bank B. And there's a good reason for it, because, just like in risk assets, banks also compete, and, Bank B might have many more applicants, that are qualified and they need more money. So they're signaling to the markets, right? They're signaling we need more money here, not as much as Bank A.
Right.
And that makes our economy efficient, because then when they signal to the market, we know where to transfer our resources, right? We know where to put our resources where they're needed.
Sure.
And in risk asset, the same thing is happening, right? Every day, that's the same thing happening in risk assets. So when this scenario is, I think, pretty easy. And then when you're looking at scenario, let's do scenario number 2. And by the way, when you look at this, if you're just the customer and you're doing it one time, and probably won't, it's not going to matter much if you missed it, right? The 2.25 versus 2. But
Right.
if you're in a business, if this is your business, is this where you're going to be generating your income? Then it becomes important not only to see 2 banks, but to know all the banks, right? To know what all the banks are paying, so you could put your money where you could get the most return for the same risk.
Sure.
Right. So, and that's one of the reasons why we have, so that's one of the reasons why we also have these screeners, so when we have these screeners, what we're doing is we're going through and, like, for example, credit put spread, we're scanning the entire market to see where are the best opportunities in the marketplace. So we could look, where should we put our money, based on that criteria.
Yeah,
that's why we're screening it, right? So that's why we use screeners a lot of times.
Yep.
Same thing. Oops, did I bring you back up?
I got myself.
Did I bring your face back?
You're all right. You're
Should
good.
I close it?
You're good. Yeah, you can close that.
Okay.
Yeah, so that's what the screeners are for.
So that's what the screener is for, right? Mm-hmm. Just like if you had a tool, right? If you had a tool that
Oh, you there, brother? Oh, I lost Dmitry for a second. Let's see if we get him back. Good old Dmitry. Love it, man. Why is it always with Dmitry I have technical challenges? Why does that happen with Dmitry? You there, Dmitry?
Oh, yep. Did I lose you?
I wonder why it's always with you I have these technical challenges.
I don't know. Hold on.
You're all good. Go ahead and share your screen, man. I got you back.
Okay. All right. Let's see.
Well, I can say technical challenges are part of the game. And if you're doing live technical challenge, it's amazing when you see like TV NFL games that those things don't go off all the time. No, don't hit the X there. Hit the small. Make that small. Yeah, like make it small. There you go.
Okay, and then close.
Yeah, you can
Is
X
that good?
We're good.
Okay. And oftentimes when you're looking at financial models, they're going to be compared to the risk-free rate, because once you move away from risk-free into a risk asset,
you
need to make more, right? You need to generate more, or why move it, right? So it has to be compelling enough for you to risk losing money. And oftentimes what you want to do is, well, for every dollar that I risk, I risk losing $1. Mm-hmm. What can I get? So then if you have, well, Bank A has a different type of instrument, and Bank B has an instrument too, where maybe there's like, I don't know, 10% chance or whatever percent chance you could lose $1.
Right.
But Bank A is saying that for every dollar, you risk, your reward is 30 cents. You can get 30 cents back in a month time. Mm-hmm. We have this note, whatever it is, like they have the note, there's some risk to it, but you'll get 30 cents. And this one, for the same types of risk, gives you 35 cents. So here, again, the choice is obvious, right?
Right.
Then you should go for the same risk. If I'm risking $1, but my reward is 35 cents, then Bank B is the best choice.
Right.
Right. Or we could go even in reverse. Let's just do this. What if there's a reward, right? Everybody's giving you a reward of 35 cents, but Bank A says and then you have bank B. So bank A says you have to risk $1,
Mm-hmm.
right? And bank B says, well, you have to risk a
Right.
dollar, right? $1.25. Well, then the obvious choice is bank A in
Sure.
this scenario, right? So bank A, because you're risking less for the same reward.
Yep.
And that's how you start to look at financial assets. Where can I put my money where I get the most reward for the lowest possible risk?
Sure.
Right? And kind of this has to be painted for you, right?
Yeah.
It has to be defined, or you're guessing.
Yep.
And
well, people love to guess.
people love to guess, and that's where you get in
People
trouble.
naturally believe they are intuitive, like so intuitive.
Yeah.
I mean,
well,
we all do, right? It's a core belief of human.
Exactly.
It's human nature to the core, right? You know.
Well, that's where you get most, and when I talk to people who start trading, and a lot of times their strategy is, well, I want to get real-time prices, and my trading strategy is I'm going to feel it where it's going. I'm going to feel it. That's my, but
Oh,
try
man.
to sell that model to Goldman Sachs.
We all believe we can, touch the divine, man. I mean, it's crazy.
Yeah.
I saw something that a woman the other day on Twitter was like, I'm so excited. I mean, not that it mattered that it was a woman or whatever, but she was like, I'm so excited. I just opened my Robinhood account. They make it so easy to trade. And I'm like, yeah, so do casinos. I mean, seriously.
Yeah. It should be easy.
Yeah.
That part should be easy.
Yeah.
So, and we'll take an example. Let's compare two different types of strategies. What if you're looking at, should I sell a put, like just sell an outright naked put, downside put, or should I do a credit put spread? What is the better deal, right? How would I determine this? And let's just paint ourselves the picture.
Okay.
Right. And I'm not gonna use real, I'm just gonna use made up data to make it easier to see and calculate.
Sure.
So let's just assume the stock is $100, right? And let's just say there's 20 days to go. Doesn't really matter right now because we're just making this stuff up.
Yep.
And we have two choices. One is we have just a naked put, we just sell it, or the other, and let's just say for the naked put, the strike is 90, right? So we're selling a 90 strike put. The stock is $100, so it's out of the money.
Right.
The stock has to fall below $90, from 100 to below $90 for this put to start being in the money, or for the stock to go through the strike. And let's compare that to let's do a put spread. Let's do a put spread. And in the put spread, we're going to sell the 90 strike, and we're going to buy, let's say, the 85 strike.
Okay.
The strike below.
Yep.
To protect ourselves. And then we'll put the reward. So this is the instrument we're trading, right? This is the instrument. Then let's put the premium for this naked put is, let's assume it's $2, right? And let's say the premium for the spread is 80 cents. So that's what we're looking at right now.
Gotcha.
Well, what's the better deal, right? What is the better deal if we, based on what we perceive as our risk? Right. So what is our risk, and what is, we know the reward, right? One is $2, one is 80 cents. So the reward is already defined for us in this scenario. What is our risk? So let's just take let's just say it's SPY. We're going to do an unrealistic one first. And let's just say the stock is $0, right? Is 0 in 20 days, right? So in this situation, we know, well, if the stock goes to 0, we sold the 90 strike, and we received $2. So really, our loss is $88.
Right.
All right. That's our risk. So we are looking to make $2, and we're risking $88.
Gotcha.
Okay. In this situation, we know that we're risking 80 cents, right?
Right.
But I'm sorry, we're looking to make 80 cents, but our risk at the stock 0 is $5 because we're stopped out.
The spread, right?
So it's $5, right? And if I compare this, which will be like what they call like max drawdown or the max loss, and this is just one way to compare your risk.
Sure.
In this situation, I'm looking to make about, I think, what is like 2.2% on the money that I'm risking.
Yep.
Right. In this situation, I'm looking to make, I think it was like something like 19%.
Yep.
Right. On what I'm risk. So reward, this is like your reward risk. Oops. Reward risk ratio. Right.
Yep.
So if we thought this was if we thought this was the scenario that the stock could go to 0 in 20 days, then we should be doing that put spread. Let's just say whatever the probability is, it's going to either go to 0 or going to go up, right? Then we should be doing the put spread because we're looking to make 19% on the money for every dollar we have at risk versus making 2.2% in this situation. But let's just change the scenario because this is where now when you're building a model, right, you have to come up with assumptions. A lot of models come up with assumptions. That's why there's reward, right, because it's not very clearly defined. And let's just say an assumption, I'll show you. Let's say, let's say it's SPY, and I kind of did this earlier. If SPY in 20 days, any 20-day period, right? If you held it in the last 10 years, I kind of just like ran those results, and I saw that the max down move was 16.3%.
Right.
So let's just say we're going to use that, as we think, that happened one time. Let's use that as our max, and I'm just going to do like 15% to make this calculation easier. All right. So at 15%. If we run this model at 15%, the stock goes from 100 to 85, right? So from 100 to 85, if we think that's our max loss, then all of a sudden, let's just do this, a minus 15%. Can you still see everything?
Yeah. We got a little bit. You got a couple more lines of space there.
Yeah. Let me see if I can move it up here a little bit. I'm going to move this whole thing a little bit higher.
Yep.
Okay, so let's just say the stock, I'm going to rewrite this so it's easier to see what's going on. So let's say the stock is down 15%, right? At 15%, that means this stock went to 85,
right? From
100 to 85, right? So with the stock at 85, our naked put would have been worth $5. So it's $2 versus, so we're looking to make $2 for risking $5, right? In this situation, in our spread, it's the same thing. We're looking to make 80 cents to make, I'm sorry, we're looking to make 80 cents for risking $5.
Right.
So exactly the same. So if you think this is the scenario, right now, it kind of flipped on us, right? Because here you're, what is that, like let me see that. Is that like 25%, right? So 2 and 5 is like 40%.
Mm-hmm.
Sorry. So 40% here, right? You're looking to make 40% on what you have at risk. And here you still have that 19%.
Yep.
Right? So
Actually, I did the
that's
math at 16%. I got my phone out here.
16%. Okay, yeah.
16%, yeah.
All right. 16%. That's right. Let's fix these. Let's fix these up. I know I'm going to get some emails now.
I thought you were a math wizard, Dmitry.
Yeah. I'm doing this really quickly.
You don't have to be a math wizard when you have Excel and a calculator.
It's harder to do this than trade. You know, when I'm trading, it's much clearer to me. And that's important. You know why you want to have everything in front of you, not just writing it out like this on the fly.
Yep.
You know, but when you have it all out in front of you, then it makes much more sense. Okay, given this scenario, then this is the better deal.
Mm-hmm.
Right? And that's how you would define your risk and compare like assets, right? You're trying to determine which one should I do.
Yep.
And then you kind of try to make realistic assumptions, and then you go for the one that offers you the better reward for the risk.
Sure.
Does that make sense?
You can see how incredibly complex this can get very, very quickly. You see how this can get very complex very, very quickly as you add in all sorts of factors that can adjust and change these sort of things.
Right.
Yep.
Right. Because and the idea is you start out slow, right? When you're building a model, the model will always, just like any business model, it always gets more complex. You know, it doesn't start out complex. It just becomes, as you get better at it.
As you get better and bigger and everything. Yes. Yep.
Yeah. As you develop it and you get better and you want to optimize it, you improve it. But you have to start with the building blocks, right? You have to know if you're going to play chess, the first thing you want to know is, well, what are the rules and how do I move my pieces around? And then you get better and better at it. So here is just one example I was showing you, and I think you could get the idea of how to expand on it. Obviously, there's there's an unlimited types of scenarios we could paint here, but
sure.
The concept behind it. And another way, so this is like when you're comparing it to a max drawdown. Another way, when traders compare, well, the risk reward is what we call like a Sharpe ratio, and they'll take the expected return, the expected positive return, divided by the variance around that return, or the standard deviation around that return. Right. And I'll give you maybe an example here.
Sure.
I think we use it over here. Like, for example, these are option strategies around earnings. So over here, what this is saying is this option strategy, done, if you did it one day after earnings and closed it out two days after earnings, was a winner 83% of the time.
Yep.
This was the average return. Then you have your median return, you have your best and worst statistics here.
Yep.
And you have your standard deviation. How much did the returns fluctuate around the average? And then when you take this average return divided by your standard deviation, you get a Sharpe ratio.
Yep.
So the higher the Sharpe ratio, the better, right? And you're always trying to do that. Look for high Sharpe ratios, because you want, the best would be, if you have this return and it was exactly this every time, then you have no standard deviation, right? You could just count on it. But and that's another metric traders will use in their models to determine where should they allocate their risk capital.
Yep.
Does that make sense? So hopefully, that helps a lot of people, and it answers some of the questions that I've been getting emails with.
Oh man, it's like you get these questions all day and twice on Sunday.
Yeah. And that's the building blocks.
Absolutely. Right? Why don't you go ahead, stop sharing your screen, bring your face up. Remember, everybody, click that subscribe button, tick that bell if you're here on YouTube. If you're on the Chameleon, you're joining us on the Chameleon, you're watching us on the Chameleon. Remember, top right-hand corner, click that subscribe button. You can start looking and diving in to all this data and information that the Chameleon provides. All these things, sharp ratios, win rates, all this stuff, which you could never do by yourself. Just give you that awesome information.